And the battle to rein inflation and stabilize the FX market has led to a jumbo rate hike and jump in the cash reserve ratio for banks. But how can the real sector be protected in times of rate hikes? Is it even possible to do that, at this point? Joining me now is Professor Segun Ajibola, Professor of Economics at Babcock University and the past president, Chartered Institute of Bankers of Nigeria. Great to have you on the show, Professor.
Thank you very much. Good morning.
Yeah, good morning. It's the start of a fresh new week, and definitely right now, everyone wants to know the way forward. And we've seen the rate hikes at this time. It's been a long time coming. And this one, the last MPC meeting, was the biggest one we've seen, so far, 400 basis points. So at the end of the day, it begs the question, is it possible to tame inflation, with Nigeria's case, without the risk of tanking the economy?
It's possible to tame inflation, but the right course must be taken.
Right.
There are 3 things that must follow themselves in quick succession. Our economy, as of today, what's the problem? Have we properly diagnosed the problem? So there's the issue of diagnosis. Then, are we prescribed appropriate policies, strategies, initiatives to change the course of the economy as of today? We should put this in perspectives. Then we now ask ourselves, what is the way forward? If we look at what is happening as of today, we look at inflation, we look at the overall economy. I am not too sure if we are following the right track in taming this monster called inflation. If we look at the monetary authorities, let's single out the 2 most significant variables that have been attacked in recent past. First is the question of cash reserve ratio. Second is the question of monetary policy rate. Let's look at the cash reserve ratio. We must admit that the central bank is carrying out its statutory function of being bankers' bank. So, as you and me patronize our banks, commercial banks also patronize central bank. That's 1. 2, we must also appreciate the fact that the monetary authority struggles to look at the quantum of money in circulation, that is money supply. Is money supply excessive? If it's excessive, elementary definition.
Over 70 trillion, at the last count. 78,
between 78 and 80 trillion,
right,
as of today. But the cash component of it is just a little over 3 trillion. So if it's too much in circulation, then the elementary definition of inflation, too much money in the economy, in the system, chasing fewer goods, will apply. I'm coming back to that. So when we now look at the cash reserve ratio, I'm taking that first, moving from just 32.5% to 45%.
That's the highest we've ever seen.
The highest we've ever seen. The immediate implication is this. With every 100 naira deposit coming to a bank, 45 naira goes to central bank as reserve. And that means central bank is still playing its statutory role of being lender of last resort. In case there is any problem, liquidity problem, a bank is facing, you run back to that reserve to solve that temporary problem. But the first implication is that you are left with 55 naira out of every 100 naira. You must apply that 55 naira first to cover the cost of mobilizing 100 naira. So, which means at any point in time, you look back, how much has it cost you to mobilize 100 naira?
And as a business, you know, definitely I might need a loan to run some of my day-to-day expenses. So if I go to the bank, there's a huge chance that I might not get any credit.
So if you now have to cover all your expenses with 55 naira out of every 100 naira to conduct business, you can imagine the implication of that on the lending rate.
So we're seeing lending rates really high at this time, but at the end of the day, the banks will not even have enough to lend out at this time.
Exactly. So you see the rate jumping up because of the implication of applying 55 naira to generate enough business to pay for 100 naira. So that's the first implication. Now, it's the same thing for the monetary policy rate, moving by 400 basis points from 18.75 to 22.75. So the implication of both is that rates in the system will go up. Treasury bill rate has given the lead.
Which is good for the fixed income traders at this point.
Which is 19% per annum. Now, when you look at TB rate, perhaps the safest form of investment in our environment as of today, going for 19%, then you ask yourself, you and me, whatever we have that is excess liquidity in our hand, and we go back to our bank now, how much do we want to collect in terms of a deposit rate? Definitely it will be much, much higher than what it used to be. The monetary policy rate, which is often referred to as reference rate, used to be totally disconnected from other rates at the time, 2 years back, when the monetary policy rate was about 17% thereabout. Treasury rate was running at 6-7%. So the deposit rate 5% and so on and so forth. But I think what the monetary authorities try to do now is to move those rates closer. By so doing, if treasury rate is going for 19-20%, imagine what deposit rates will go for.
All right, Prof. But
at the end of the day, lending rate will definitely jump maybe to about 30-something%.
Right.
Then we start asking ourselves the question, how many need all this, a combination of this, to work in my farm, to bring out yam to the market? So somebody will say, yam is not imported. What of the inputs to produce yam? Ditto for all other products.
Right.
Then even those ones that we import, exchange rate has translated into higher cost, landing cost, per unit cost. So at the end of the day, going to the market, you see increases in all these commodities.
And you need,
what can we do
to
battle that side?
Right.
Rather than mopping up.
So Prof, so much to unpack there, but it's just that we've run out of time, at this time. But we'll definitely, continue the conversation. Thank you so much. We're hoping for some kind of soft landing at some point, even though we know everyone's expecting a hard landing with what's going on. Professor Segun Majibola, Professor of Economics at Babcock University and past President, Chartered Institute of Bankers of Nigeria. It was great having you today, sir. Thank you so much.
Thank you very much.
Thank you so much, Prof.